Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the SPY, the QQQ, and most of your market was indeed higher after we got a very good Fed meeting. Jerome Powell was actually nice to us for a change. Now, we did get the 0.25% interest rate cut as the markets had anticipated, but the summary of economic projections was also fairly good, with raised guidance in terms of forward GDP estimates, slightly lowered inflation estimates for 2026, and a somewhat awkward similar rate cut path, with a lot of people saying they should be cutting rates faster, but the Fed really holding strong on its data-dependent status. Now, today was a very good day throughout the Fed meeting and into the close. However, we had something happen in the after hours, which is why you're seeing the futures market down tremendously right now. And of course, that had to do with Oracle earnings. Oracle coming out with their earnings after the bell, and although they posted good numbers, the stock right now down over 11% and dragging a lot of the big tech players down with it. So in today's video, guys, we have a lot of things to talk about. Number one, of course, we're going to recap the Federal Reserve interest rate meeting today, what was said and what are the projections into 2026. Thereafter, we have two earnings reports to cover, of course. Number one is going to be Oracle, and number two is going to be Adobe, and we're going to gauge Oracle's impact on the market right now. Thereafter, we'll get into our technical analysis portion of the video, where we go over the major indexes right here, the SPY, the QQQ, and our minor sectors. Take a look at the market breadth, take a look at the market rotation. Is it healthy? Is it not? Thereafter, we will do a similar analysis on our big tech names, technical analysis across the board here, and derive of all of these beautiful tech names, which ones are buys, either for swing trades or long-term portfolio holds, as we know that a lot of big tech names, guys, have just been doing a whole lot of nothing since November, right? Names like AMD, Amazon, Meta, Microsoft, Netflix, NVIDIA, not doing everything with a downward bias. So are any of these names good to possibly pick up into the end of the year? And at the very end of the video, we will take a brief look at the biggest gainers and losers of the day. We won't have that much time to do it because we're covering earnings, but I do want to point out a few key players which could be quite interesting here into the end of December and into 2026 as well. So it should be a very action-packed video, guys. Let's jump right into it. And just before we do, I do apologize. Yesterday wasn't here for the video. I did post a message on the channel. Hopefully you guys saw it, but I had a few personal things and family things to take care of yesterday and even tonight, which is why I'm uploading the video very late. But I'm not going to miss 2 days in a row, so I guess better late than never, right? But let's jump right into today's action. So the SPY up 0.66 on the day, the Q's up 0.41, but we may just erase all of those gains come tomorrow morning. That being said, today was a very nice day in terms of market breadth. You will see here that most of the market participated to the upside and in a very big way, although we were missing Microsoft because of new CapEx guidance, and we were missing names like Meta and Netflix as well. The rest of big tech, not too bad. NVIDIA just hasn't been showing up for the past few weeks, unfortunately, but other big tech names did quite well. Broadcom, which has earnings tomorrow, Apple, Amazon, Tesla, and Google trying their best to hold everything together. On the banking side here, financials not too bad, although the credit cards continue to lag ever so slightly. It was a very nice day of recovery for the banks just because of that rate cut and the forward guidance for 2026 from the Fed, which we will get into, of course. Healthcare, decent little bounce today after the last few days of being just red, consolidation mode. Healthcare putting in a nice little bid for the market overall, and the bottom half of the market not doing too poorly as well. Consumer staples dragged down a little bit by Walmart and Costco, but the rest doing fine. And the bottom half of the market, which is somewhat interest rate sensitive, did benefit from some very nice gains today. So that being said, not too bad of a day, honestly. GE Vernova up 15%, which was absolutely massive on their renewed guidance for 2026. But overall, guys, a decently broad day, although we are lower in the futures market right now, which is really synonymous with some losses in big tech. We will seek to understand whether or not tomorrow could be a very healthy day, right? If it's only big tech that's down tomorrow, big tech and semiconductors, and the rest of the market is broad, that's not too bad. If they take everything with them, well, sadly, it's going to be a much different picture leading into the end of the week, right? Moving into the one-day relative, you can see even better how nice the market breadth was today. Most of your major sectors were indeed higher, except for utilities. On your 1 week relative, well, we're still kind of balanced, right? Several major sectors still down. Although utilities, healthcare, defensives, real estate, and energy are down, got some nice performance on the top side here with technology, industrials, and financials. We may lose a bit of technology into the tomorrow session, but just to say, right, market breadth has not been too bad. It's been a lot better, of course, than what we saw in the month of November, but still, some of your technology aspects, especially the big tech names, are lagging a little bit behind. And because yields went kind of on a bit of a tear, right? The US 10-year right now in the last week and a half, and the 20-year bonds, since they went on a bit of a tear, we kind of lost the bottom half of the market, which is sensitive to those interest rates, such as utilities, defensives, and real estate overall. So those are the reasons why those sectors are currently still on the lows. Fear and greed still remains in a fearful environment right now, as your market momentum is somewhat neutral, but the stock price strength, right? Net new 52-week highs and lows. We're not really seeing many 52-week new highs in the market overall. Are there certain small pockets of strength? Yes, but overall, I would say we're just recovering the November dip. So I'll remind you, this indicator right here is not a question of how people are feeling. It all has to do with certain momentum indicators, right? And your stock price breadth as well, the McClellan Volume Summation Index, is curling up higher, much better than it was earlier in the month of November, but still, people are kind of on the fence in terms of 2026 because there are still some bearish narratives at play right here, which is why, although the short-term market breadth has been improving, your longer-term market breadth, such as the percentage of stocks above their 50-day EMA, right? Well, unfortunately, we're not that high. I wouldn't say we were as bullish as we were back in the summer months overall, but it has been improving notably since the end of October and into early November as well. So still in the markets, guys, a lot of conflicting data right now. It is a constant battle between your short-term bearish narratives, which we've recapped many times on the channel, right? These short-term bearish narratives, the most powerful of which are the AI bubble, the jobs market slowing down a little bit, and the K-shaped economy in terms of the consumer status, right? Those are the current bearish narratives at play, which is why, although some sectors come alive at a certain point, such as, consumer staples and sometimes even consumer retail, they come alive briefly, and then you can't just sustain these rallies, at least not on everything, right? So it's been getting better, but still very choppy overall in the markets. But if you just look at the SPY, you can't really see it, you know what I mean? But it is still a very bifurcated market. You remember when I showed you the S&P 500 year-to-date gainers and losers, this chart right here, whereby a lot of the gains are really made in all of the technology stocks, the data center stocks, the memory stocks as well. But you have large swaths of the market that are underperforming the S&P's year-to-date gains. The S&P year-to-date is up about 16, 17%, but only 161 names out of 503 are actually outperforming your benchmark. As a matter of fact, most of the market is underperforming the benchmark. And you'll see here in terms of the names that are negative, right? You got about 200 names that are negative on the year. And of those names that are negative, so many names here, so many decent, high quality companies are down 17, 18, 20, 25, 30, 40% overall. So really the variance and the dispersion is quite large right now, which is why a lot of these breadth and momentum indicators, although they're recovering in the short term, right? It's not an everything market, not just quite yet. So we'll get into more technical analysis after we cover our Fed details and after we cover the earnings. But speaking of the Fed details, let's jump into it right now. So when the FOMC was released, you can see that right here. We got the summary of economic projections, the pre-written statement, and then Powell started speaking, and everything was very good. Here are the key highlights. Number one is going to be this. The divided Fed approves a third rate cut this year, but does see a slower pace ahead. Now, I'll remind you, when we did the video on Monday, we had one focal point, or rather, well, the focal point was the summary of economic projections, but it was in a few different parts. So here it is, guys. The change in real GDP, you'll notice that the GDP projections from the September summary of economic projections were at 1.8%. Now, those have been revised upwards to 2.3%, which is very strong. And when asked about this in the meeting, essentially, Jerome Powell did say that a component of this was indeed due to the advancements in AI and the infrastructure build-out. The GDP rates for 2027 were also brought up from 1.9 to 2.0. So check number one for the bulls. That's very, very decent. The economy supposed to still be doing pretty well in 2026. What about the jobs, though? The unemployment rate, the Fed sees exactly what they did see back in September, also saying it's a no hiring but no firing environment. Unemployment rate projections at 4.4% for 2026, which is the exact same as we had in September. For 2027, though, you got a bit of a dip here from 4.3 to 4.2. So the Fed not really seeing any structural damage with employment just yet. Now, we've talked about this many times on the channel. We talked about the headlines just last week after the Challenger jobs report saying that there was 1.1 million jobs cut in total throughout 2025, which is a historical very large number, of course. But when you look deep into the numbers, who is cutting those jobs and why? Well, it's a bunch of companies like Intel, UPS, Verizon, right? They cut a bunch of people, but because they have execution problems, not necessarily because the economy is not good. No, it's either they hired too many people in 2022, or number two, they are revamping the company, such as Verizon, cutting around 15,000 employees because they've been doing pretty much nothing in the past few years, and the new CEO is coming in with a big cost-cutting plan. Not that the business is structurally bound by a weak economy or anything like that. UPS is kind of the same thing. They lost a very large, well, they didn't lose it. They chose to not renew an Amazon contract. So they cut like 70,000 workers. And then Intel's just been a bloated company for the last half a decade at this point. And as a result, the new CEO, right, is cutting costs where he can, not necessarily because the economy is bad, but a lot of those businesses had either execution problems or just a bloated workforce that was obtained during 2021 and 2022. The other portion of jobs that were lost for a majority are related to AI gains, such as the workforce cuts that we've seen in companies like Amazon or across other big tech names such as Microsoft, Meta, and the likes of that. And you might remember when we went over the Challenger jobs report last week, it only showed that a very small percentage of the workforce was actually laid off due to pricing pressures from the result of tariffs. As a matter of fact, only 8,000 people were quoted as being laid off due to tariffs. So that's why the Fed still says that it's a no hiring, no firing environment. There are many jobs available, especially in construction and infrastructure right now. But in terms of white collar jobs being replaced by AI, that's a very real threat, obviously, right? So this situation will have to be monitored, but 4.4%. The PCE, and see, these numbers without context, right? It doesn't matter. You got to understand the context. The PCE inflation, we got a nice downtick there from the September projection of 2.6% into 2026 down to 2.4, which once again goes in line with what the Fed has been saying and what many analysts have been saying as well, that the short-term impacts of inflation will just be one-time events from tariffs, essentially, right? And that as we ease into 2026, those one-time impacts will largely work their way into the economy. This was good. And then the core PCE number down as well. The only thing that the market didn't truly appreciate is the path of interest rate cuts. The path of interest rate cuts stayed exactly the same. And if you keep this number as it is, that just means that the Fed will only maybe be cutting 1 or 2 times into 2026. Once again today, Jerome Powell referencing the data-dependent nature of the Fed. They are in a good position, he said, to wait for the data to come in. The labor market is not structurally very weak right now. Number 2, GDP rates still remain very strong. And number 3, inflation isn't super problematic as of yet, although it is still above their 2% target. So they feel like they can afford to wait a little bit longer before providing us with an accelerated rate cut path. Now, that's either positive or, you can say pros or cons for that, right? If the Fed showed us an accelerated rate cut path with a higher unemployment projection, well, that means they're very nervous and they're cutting rates in a reactive fashion because the economy is currently unwinding, right? If they stay firm on their interest rate cut projections and the jobs data is also quite firm for them, well, although the market doesn't like it and could throw a bit of a tantrum by saying, well, we're not getting the rate cuts that we want, well, at least it's not because the economy is somewhat structurally falling off a cliff, right? So as I said, there are pros and cons to this analysis overall. Several other key highlights that we'll talk about as well is that the central bank will start buying $40 billion in treasury bills beginning Friday with a few more scheduled events. Now, the interest rates now obviously 3.5 to 3.75. The interest rate cut projections or probabilities for the January meeting stand at about 22%. Not the greatest odds. In my opinion, January will also be a wait and see month. They'll probably not cut it all and they'll probably still stay on their data dependent narrative right now. Now, in terms of other highlights here, Fed Chair Jerome Powell at his post-meeting news conference said the reduction puts the Fed in a comfortable position as far as rates go, as I was previously describing. We are well positioned to wait and see how the economy evolves. We're in the high end of the range of neutral. It's so happened that we've cut 3 times. We haven't made any decision about January, but as I said, we think we're well positioned to wait and see how the economy performs. And although there were a few Fed members that were dissenting from this view, right, you can see that the dissents in terms of the dot plot, there's not that many people that are kind of off the course, right? Many people are kind of in line right now. You don't want to see dots all over the place. That would mean that more and more Fed members are dissenting, which is not the best for the market narrative. So although we do have 3 overall dissenting members from the pack, which is this one right here, this one down there, and this one down there, overall, it is roughly in line, right? The range is not that egregious, in my humble opinion, for the dot plot. So moving on a little bit further, the central bank will be buying $40 billion in treasury bills beginning Friday. From there, purchases are expected to remain elevated for a few months, then likely will be significantly reduced. This is the Fed's ability to purchase, short-term treasuries to boost liquidity in the markets overall. You know that quantitative tightening ended on December the 1st, and now the Fed will be providing a little bit of liquidity relief in the market sporadically over the next few months. So this is also something to pay attention to. To be quite honest with you guys, today's meeting with the Fed was actually very good. You would be hard-pressed to be upset at Jerome Powell for anything other than if you do want him to cut rates in an accelerated manner. The data is not too bad. They constantly say that it's a no hiring, no firing economy, which arguably is true, right? In terms of the jobs available, there's still a lot of jobs available, but companies are not struggling to find people for work. But at the same time, they're also not rushing out there to hire new people, right? So anecdotally, you and your friends might think it's a very tough jobs market, and that might be true, but are companies laying off people by the hundreds of thousands because they are worried about an economic collapse or economic recession? Well, the answer is no. The data is a bit more nuanced than that, right? That's everything for your Fed analysis. Hopefully you guys enjoyed that. Now, let's get into some earnings and kind of explain what happened here. Why are we down so much in the futures market? And could we possibly be big red tomorrow? Well, yeah, we can possibly be big red tomorrow. I guess we'll have to seek to have AVGO save us once again, right? So that being said, Oracle dropping the entire market, Oracle having earnings, and the market, although the numbers were decent, they didn't like it, right? This is algos selling on the print, of course, but there's a few key things that we have to understand about Oracle. Oracle is a very solid company, but the narrative, it's not so clear as like it was before when they had this huge 35-40% earnings pop with a ton of RPOs, remaining performance obligations, because the risk is very concentrated to one player right now. And if I had to sum it up, and we will talk about this all throughout my analysis, right? The reason Oracle is down right now is because people are asking themselves the following question. Is Oracle currently building for a tenant that can't meet its obligations? Talking about good old Sam Altman and OpenAI that has $60 billion in yearly commitments, but only has $13 billion in revenue. We've been bringing up this problem now for about the last month and a half. There used to be a time about a month and a half ago, 2 months ago in September and August, whereby OpenAI was striking deals with everybody. It seemed as though every few days there was a new OpenAI deal for $6 billion, $10 billion, $100 billion, $300 billion in the case of Oracle. And now people are actually asking themselves the question, is OpenAI good for the money? And since OpenAI is Oracle's largest client, and unfortunately management didn't really provide any insight on the earnings call as to whether or not they deemed that client to be good for its money, well, there is still more uncertainty surrounding the Oracle trade. Now let's go over the numbers and we'll explain the narratives, because we know that a stock's price is a reflection of 3 key things. Number 1, the technicals. Number 2, the fundamentals. But number 3, the sentiment and narrative, which is also a very powerful thing that can move stock prices, right? Moving on, just ask Adobe, who we'll cover after, that's been net down despite showing beautiful earnings this entire time. The AI narrative is just too strong for this stock right now, right? But let's talk about Oracle first. Oracle right now reporting numbers. They beat on EPS, but this is fake EPS. They chose to realize a portion of their sale, right? So we'll talk about that too. How they sold off a portion of their business, and they chose to realize that this quarter, if you were to remove that impact, EPS would have roughly come in line. So this is a bit of a fake EPS beat by 40% there, but I mean, it is their right to recognize that profit or that sale in this quarter right now. Moving on to the revenue aspect, they missed by about 1%. So how does a company that has such an enormous backlog and such theoretical, beautiful EPS growth, look at this theoretical, and I say theoretical for a reason, theoretical EPS growth into 2028 and theoretical, immense revenue growth power, why is it down 11% despite posting very good numbers? Well, it's all about the narrative, right? So here you go. Oracle, sales, missed on EBIT as well, and the EPS was a beat, but as I said, it's a overly sized beat because of the sale of Ampere technology, right? So moving on to the easy numbers from Oracle here, guys. Not too bad. Revenue was up 14% year over year. Cloud revenue 34% year over year. This is the bigger growth driver for the business. Of course, remaining performance obligations up to $523 billion. You might remember that $300 billion jump from last quarter, largely in part to Project Stargate and OpenAI. And now they've added an additional almost $70 billion on top of that, with renewed commitments from several big tech players. Operating income was doing good here at 10% year over year, and their operating margins stayed relatively stable. Now, taking a look at Oracle Corporation, this is the sheer size of the remaining performance obligation boost. So, but once again, guys, right? $300 billion from OpenAI. Will they be good for the money? That's why the algorithms, and that's why some institutional investors are just not convinced that these remaining performance obligations are fully real or fully able to be realized into the future, right? Keep in mind, these remaining performance obligations, guys, these are not contractually signed agreements. These are LOIs. They are letters of intent. Almost all of OpenAI's deals right now are LOIs, not contractually signed obligations, which means if they choose not to go through with that spending, Oracle can't sue the company for breach of contract. No, it's just a letter of intent, which is why, for now, at least, some people are taking these numbers with a large grain of salt. Moving on further here, you can see that Oracle's earnings were not all rosy. They actually missed on their cloud revenue estimate, even though it was very strong. They missed on that estimate, right? Software revenue right here was also a miss, down 3% year over year. In terms of cloud applications, that was also flat in relation to the estimate. So they're only beating on a few things here. Non-GAAP operating income, that was also a miss. Although it was up year over year, it was missing the estimates. And non-GAAP operating margins, also a miss, 42 versus the 42.2% expected. So as you can see right here, a lot of their numbers missed the expectations. Now, when you couple that with the overall sentiment, it's very normal that you would see Oracle down in the after hours today. Now, is it warranted for them to be down 11%? That's debatable. But when you miss on so many overall numbers, you can't really expect to be up 15, 20% right now, can you? Now, here's what management had to say. Our GAAP and non-GAAP earnings per share were both positively impacted by a $2.7 billion pre-tax gain on the sale of Oracle's interest in our Ampere chip company, which is why you see those outsized EPS gains and those outsized net margins gains this quarter. Oracle sold Ampere because we no longer think it is strategic for us to continue designing, manufacturing, and using our own chips in our cloud data centers. We are now committed to a policy of chip neutrality, where we work closely with all of our CPU and GPU suppliers. Of course, we will continue to buy the latest GPUs from NVIDIA, but we need to be prepared and able to deploy whatever chips our customers want to buy. There are going to be a lot of changes in AI technology over the next few years, and we must remain agile in our response to those changes. Oracle is very good at building and running high-performance and cost-efficient cloud data centers. Because our data centers are highly automated, we can build and run more of them. Oracle has over 211 live and planned regions worldwide, more than any of our cloud competitors. We are more than halfway through building 72 Oracle multi-cloud data centers to be embedded throughout the Amazon, Google, and Microsoft clouds. Now, this is true. Oracle, as a fact, is the largest data center provider on the planet. However, right now, they do also have some concentration risk towards OpenAI. Now, the rest of these companies here, Amazon, Google, and Microsoft, are definitely good for their money, right? Definitely good for their money. But OpenAI, still a very large question mark. And that is the overhang right now with not only Oracle stock, but everything that's closely associated with any OpenAI deals, which have been coming out over the past 2-3 months. Moving on further here, talking about the debt, because this has been a big point of contention from a lot of people recently, right? How will they actually fund this AI build out? Because you guys know Oracle right now is a company with a tremendous amount of debt. And every time we cover their earnings, I say that this is the largest red flag for the business, because the revenue growth projections and remaining performance obligations, those are not true red flags. Their earnings per share growth as well, not red flags. And when the company is performing well, their net margins are also very good. However, it's the amount of debt that the company has, especially while they are burning free cash flow, building out all of these data centers, right? So keeping in mind, their debt level currently right now, as of last quarter, stood very high at about 111 billion. They are adding even more to that debt load as well, which has brought up the credit default swap ratio for this company. And this chart is a chart that everybody's going to be bringing up and has been bringing up for the last month, ever since September, when we started worrying about whether or not OpenAI could fulfill its obligations, right? You currently stand at 167 basis points for credit default swaps. It's a very fancy term just to say insurance. Essentially what this chart means is that if you have $10 million to insure for an Oracle bet right now, it'll cost you $167,000, which is roughly a 1.67% default rate risk on a yearly basis. Now, if you can do this on a cumulative fashion, right? If you go out 5 years, well, it's just 5 times 1.67, and that is the cumulative debt default probability on Oracle's debt as time moves on. Now, obviously, you can see a massive upswing here since they signed those remaining performance obligations with OpenAI. So people are a little bit nervous whether or not Oracle will be able to serve all the debt that they're taking on for these data centers, because if their clients don't pay, well, they'll spend a bunch of money, and then they'll have to find, obviously, new clients to fill that void overall. Now, the CEO had to actually say something about all this. We don't actually incur any expenses for these large data centers until they're actually operational. There are a variety of sources available to us throughout our debt structure in public bond banks and private debt markets. Customers may bring their own chips to be installed in our data centers, and suppliers who may lease their chips rather than sell them. Both of these options enable Oracle to synchronize our payments with our receipts and borrow substantially less than most people are modeling. So, shouting out a lot of the analysts that are modeling huge capital expenditures immediately and huge expense profiles immediately. Oracle saying, no, it's not that simple. We kind of do just-in-time expense management, right? We expect and are committed to maintaining our investment grade debt rating. So that being said, that's all the things we had to talk about with Oracle as well. They also did one key factor here, which we did not talk about as well here, guys, which is they raised their CapEx profile overall. They raised it to $50 billion as opposed to the $25 billion that they committed to earlier in September. So that was a big CapEx raise, obviously. And as a result, unfortunately, their free cash flow has taken a hit, negative $10 billion in free cash flow. The consensus was for minus $5 billion. So not only did Oracle miss on a lot of their, headline numbers right here, but also free cash flow came in much more negative than people were anticipating, and the CapEx came in a lot higher. So all these reasons together, plus the OpenAI narrative, is why the stock is currently down 11% in the after hours. But it's not only them. NVIDIA is currently down in the after hours right now, and you can look at the other cloud data center providers such as Iris Energy is down in the after hours, NBIS is down in the after hours, Microsoft is down in the after hours, anybody who is CoreWeave is down huge in the after hours as well. Anybody who is building data centers right now is currently down in the after hours. So Oracle really sent a shockwave throughout the markets, and you can see it's getting worse as I'm continuing to make this video. 1% on the SPY and 1.5% on the QQQs, which just goes to reiterate these fears right here, right? The AI bubble and the fact that the market is overvalued. In other words, right? Not so much of the market is overvalued right now, but have these companies committed too much money too soon, knowing the fact that the revenue generation from all of these buildouts may only be seen late 2026, 2027, and 2028. So has the market priced in too much growth too quickly? That is why we keep seeing these ripple effects since the month of November. Basically, have things ran too fast for what they're actually worth right now, right? So that being said, Oracle right now, in terms of the fundamental valuation, guys, it's very tough to do because it depends which side of the aisle you stand on. If you believe that OpenAI is good for their money and that all the remaining performance obligations for the company will be fulfilled and they will realize those revenues and they won't bankrupt themselves in the process and their expense profile will be kept under control, well, you can believe these very bullish numbers. I mean, look at this EPS. It accelerates into 2027, 2028. Look at this revenue as well. It accelerates into 2027 and 2028. The problem is that's still a long ways away. And although the market is forward-looking, If you give it some negative sentiment, well, it'll price that in right now, and then maybe it's just going to wait to see if the numbers actually manifest themselves. So although I do have some forward projections right here, it's not so simple, right? Their current, at around $200 where they are in the after hours right now, the price to earnings is a 425. Not that bad. If you take into consideration their massive EPS growth of 30% per year on average, which is accelerating end of 2026 into 2027, 2028, it's an EPS growth rate of 30%, which is massive. Revenue growth rate, even higher, 38% per year. But as I said, a lot of this is on the tail end of the theory, right? Whether or not that happens is something different. But if we're modeling, well, maybe we can give ourselves a margin of safety, right? If we do give ourselves a margin of safety, I'll explain. At $200 right now, the forward peg ratio is 0.83. If you just look at this number and forget this right here, the OpenAI stuff, and just take these numbers, in an absolute form and say, well, there's no risk to them, Oracle right now looks excessively cheap. But this is where the concept of risk-adjusted returns comes in. The company's valuation may look cheap, but there's obviously a lot of risk to this narrative right now. So this trade comes with big conviction. That being said, forward price to sales is a 7, which is not very high either. So even if we were to cut this EPS growth rate in half, they would still only be at a 1.6 peg, which is not too bad. That's a big margin of safety, right? If I cut this number in half and even cut the revenue growth number in half, they're still not too bad, right? However, if you do cut those in half, do you guys think the stock's going to rally? Even though we might be at a lower valuation? No, because the market will just be, will have PTSD essentially from those numbers coming down. So which is why I say modeling Oracle right now hinges on a very large key assumption, which is the assumption that OpenAI is good for their money, that they'll be able to pretty much fulfill all of the 300 billion or close to it, right? And that will be able to translate into this actual EPS growth rate and this actual revenue growth rate. So you can see the thesis here on Oracle is not as simple as it once was, right? Are they still are they still a very solid data center provider? Absolutely. Do they still have very large commitments with other big tech players? Absolutely. But this OpenAI black swan possibility means that investors are very nervous right now, whether those are institutional investors or even some retail investors, which have flipped on the stock recently. But the valuation right now, does it warrant a risk to reward trade? Yes. Does it warrant maybe an all-in trade? Probably not, because there are some risks. But can you justify the forward multiple here around $200? The answer indeed is yes. Now, this play is not going to be for everybody, and I'm not telling you guys to buy this one overall. You have to determine whether or not you want to take on that risk, or whether you want to play it like me, where I'm playing other names that don't have the OpenAI concentration risk, such as NBIS, which their concentration risk is pretty much Microsoft and Meta, and a few other players, of course, but their concentration risk is Microsoft and Meta. Those guys are probably good for the money. Iris Energy, their concentration risk is once again companies like Microsoft, right? Or even other ones such as CIFR, another data center builder. Their concentration risk is Google and Amazon. CoreWeave has the OpenAI concentration risk as well. They also have other deals from other hyperscalers, but they have the OpenAI risk as well. If you're looking to completely stay away, right, from the OpenAI risk, well, then maybe names like IREN and NBIS and CIFR, your other data center builders, could be possibly a better choice. They're not as big as Oracle, and Oracle doesn't only do that. They have many other lines of business, of course, but that is your risk right now, especially if you're playing it for a data center build-out trade. So I spent a lot of time on this one. Obviously, I could talk about Oracle for like an hour, guys. But, we're going to cut it off right here. So hopefully you guys understand. Right now, under $200, is it a good bet? Only if you can take the assumption that the OpenAI trade, that OpenAI is going to be good for their money, or at least a majority of it, right? And that the business will continue to expand as a result. So this one, would it be a nice risk to reward trade? Yes. Will it be extremely bumpy? Absolutely. So please keep that in mind, right? It may not be as clear cut as the other smaller data center plays that don't have that risk, that are only tied to the hyperscalers themselves, right? That being said, that's everything for Oracle. Now let's jump into stock number 2, which is going to be Adobe. So Adobe coming out with their earnings, and initially they had a very nice pop, and then they had a decent drop, and they're down 1% in the after hours. But Adobe is kind of different, right? Adobe got hit with a big narrative. Of course, the narrative is AI being able to replace a portion of Adobe's consumer business, not so much their enterprise business as of just yet, because we know that's the biggest growth driver for Adobe overall. But, you know, freemium platforms such as Canva and other design platforms such as Figma as well can possibly come and compete with Adobe into the future in terms of their consumer segments, and maybe impeding as well, slowly but surely, on enterprise domination as well from Adobe. Now, as a result, though, or rather, amidst that narrative, what hasn't been going down is the numbers. It's kind of reminiscent of Google. When Google got hit with the AI narrative and the stock went down, 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 but Google kept posting good numbers. Adobe's the same thing. They have not missed a single earnings this entire year so far. But if you just looked at the stock, you would think their numbers are falling off a cliff. It's not true. As a matter of fact, they had good earnings again. They beat on EPS by 2%, and they beat on revenue by about 1.4%. Now, Adobe's numbers, guys, were really good. Like, if you're looking for the destruction narrative, you won't find it in the numbers overall. Take a look at their other metrics. Even the guidance was pretty good. Now, the guidance beats weren't incredible, but they did beat on guidance as well by about 1% on sales, even by a couple percentage points here on forward Q1 EPS as well. If you take a look at the number here, I mean, revenue growth is not 20 or 30%, but it's still a very healthy double-digit 10% per year. Remaining performance obligations were up 13% year over year, which is good. Sequentially, this is good as well, right? The last couple quarters was a bit flat, and now you got a nice little uptick here. And some of that is a result of AI. Funny enough, Adobe's also using AI, and it's actually being beneficial to their sales pipeline. Operating margins, no problem there. Their margins are very good. Operating income was up 9% year over year, and a nice smooth uptick in EPS as well. Now, some of this EPS is bolstered by a tremendous amount of buybacks that Adobe is doing right now. Over the course of this year, they bought back $12 billion in shares, with the remaining roughly $12 billion in further obligations as well. This was like 6% of the entire float this year. So kind of like PayPal, guys. I guess the biggest buyer of Adobe stock this year maybe it was just Adobe themselves, because I haven't seen many institutions start big positions in Adobe. I haven't seen really many retail traders start big positions. Everybody's just kind of nervous surrounding this narrative, but you do not see it in the numbers. We have to be fair, right? That being said, here's what management had to say. Adobe's record results reflect our growing importance in the global AI ecosystem and the rapid adoption of our AI-driven tools. By advancing our innovative, generative, and agentic platforms and expanding our customer base, oh, they hit all the keywords there. Generative, agentic, innovative, right? And expanding our customer base, we're excited to target double-digit ARR growth in 2026. Very good. No problems for Adobe, right? Adobe delivered another outstanding year, fueled by strong global demand for our AI solutions across business professionals and consumers and creative and marketing professional customer groups. Looking ahead to 2026, we are confident in our ability to deliver industry-leading innovations, double-digit ARR growth, and world-class profitability. And even during the earnings call, guys, I mean, there was no problems with this business. If AI is disrupting their business, we're definitely not seeing it in the numbers just yet. Moving on further, here are more numbers in terms of their fiscal year 2025, as now they've just concluded the entire fiscal year. So revenue was up 11% for the whole year. That's not bad, right? Total Adobe ending annual recurring revenue gains, 11.5% year over year. Good. Digital media segment. Here, I broke it down for you guys just to know what they're talking about here. Digital media, which is 75% of their business, are things like Photoshop, Lightroom, After Effects, both on a consumer grade and also professional grade, because we know they have enterprise clients. And then the digital experience version of that is marketing, analytics, and onboarding in relation to the whole software suite that Adobe offers. So those are the two things. So digital media, the largest component of their business, well, their ending ARR growth was 11.5%. Year over year revenue growth, 11%. Digital experience, which is a smaller component, right? 9% revenue growth, but subscription revenue, 11% year over year. There's not many problems here, right? Not too bad. I mean, these are not explosive revenue growth rates, but they're still very solid. And as a result, their current remaining performance obligations exiting the year were 65%, which are very solid. Moving on further here, more numbers. We talked about the $12 billion in buybacks. They reduced shares outstanding by 6%. But look at their qualitative metrics in terms of active users. Freemium monthly active users. Creative freemium users grew 35% year over year to more than 70 million. Total monthly active users, Acrobat and Adobe Express, surpassed 750 million, growing 20% year over year. No problem there. Generative credit consumption increased threefold quarter over quarter in Creative Cloud, Firefly, and Express, which are their AI tools overall. So the credit consumption, are people actually using their AI tools? Well, yeah, it increased threefold quarter over quarter, not even year over year. That's sequential quarter over quarter gains. Pretty good. Firefly first time subscriptions, which is their AI tools, right? Doubled quarter over quarter. All right. Enterprise customers, the biggest focal point of the business. You could argue, although Adobe doesn't provide, hard statistics on this, you could argue that probably a good 80% of Adobe's business is just retaining those enterprise clients, those large clients that are integrated into large firms that, it's very tough to break those subscriptions overall. Count of customers with $10 million plus with the business, their ARR rose 25% year over year, totaling over 150 clients. It's pretty decent, right? And their mobile ending ARR was up over 30% year over year. So all of these, well, some of them are quantitative hard data, but even some of the other ones, like the qualitative numbers, right? Not too bad, not too bad. Monthly active users and users overall not declining, and enterprise clients still very strong. Let's take a look at the Adobe revenue profile. You'd be hard pressed to find a problem there. They're just steadily increasing revenues. As I said, it's not 20% per year, but they've been maintaining a very steady revenue growth curve, 10 and 12% year over year, every single one of the quarters that they've reported so far. Moving on, trailing 12-month free cash flow per share. They are still generating a tremendous amount of free cash flow. Look at this free cash flow per share. And they're doing really good, right? In this quarter as well, they generated over $2 billion in free cash flow. Their profit margins are very good. We're talking about a business who generates, in terms of profit margins, let's call it like high 20s. And this quarter was no different overall too. They actually generated 30% net margins, and they just keep generating some very decent free cash flow. If you want to take a look at their free cash flow and balance sheet profile, it's not too bad either. Look at this free cash flow per quarter. It's decent, right? Not too much debt, decent cash on the balance sheet, decent free cash flow generation. So that's not the problem. Taking a look a little bit further here, one more for you. The hidden alpha, this chart says, the RPO growth is outpacing revenue growth. I mean, we talked about that when we took a look at this chart right here. The RPOs were growing faster than revenues, but this shows it as well, right? Whether you look at this quarter or previous quarters, that's always been the case. They're able to lock in more and more contracts. So their business is not declining no matter which metric you look at, whether it's active user growth or enterprise client retention or enterprise client growth, whether it's remaining performance obligation growth, whether it's their AI products, more and more people are using them. But all of that, guys, still is not enough to send Adobe up in the after hours. So that being said, this is another form of a business. See, we talked about Oracle and the problems there. Oracle is having explosive revenue growth potentially in the futures, but has a big problem with perception right now in terms of OpenAI. Adobe is not exactly the same thing. Adobe just has very steady revenue and EPS gains, steady profitability, but once again has a problem with the narrative and the sentiment. This time it's that AI is going to kill their business. So these trades don't come without narrative and sentiment risk. If you look at the numbers alone for both Oracle and Adobe, and you just invest based on the numbers, both of these companies are good deals, attractive deals. Take a look at Adobe right here. 2026 at $340 right now. They're at 13 forward PE. 13. Now, do they deserve 30 with these growth rates? Probably not. But should they maybe be trading at a fair, maybe 20 forward multiple? That wouldn't be too crazy, right? It's a 1.08 peg, which is also very low. And look at this free cash flow yield. 7% free cash flow yield. Very, very solid, right? And their business is growing. And it's growing a lot faster than something like a PayPal, right? Which has arguably not much revenue growth at all with, similar multiples, crushed multiples, good free cash flow yield, but a very low PE and a very low peg, right? But PayPal's not growing their top line right like that. Adobe's growing their top line faster. So that being said, guys, this is another example of the business where the sentiment matters arguably more than the fundamentals. Now, if you just invest off the fundamentals, eventually, I mean, Warren Buffett has said this, many other people, great investors that come before me have also said this as well, right? Eventually, the fundamentals will catch up, okay? It will start to overpower the sentiment overall. Now, this company is down 23% year over year. They're revisiting numbers that we have not seen since the bear market of 2022, and arguably since all the way back here during the COVID pandemic. So is Adobe a good buy right now? if you just look at the numbers in absolute form, yes, indeed is a good buy. But once again, you have to buy this with a thesis. The thesis is that AI is not going to disrupt and not kill their business. And that's sometimes a tough thesis to get behind. It's just like Oracle. If you're investing in this business, you have to invest with the premise that OpenAI is good for its money, won't go back on its obligations, and leave Oracle out to dry. So these are very tough asks for most investors to make, right? It's not an easy thesis to get behind. I do think there are easier trades in the market in terms of sentiment and in terms of narrative rather than Oracle and Adobe. However, if we just look at the numbers in their true form, these would be good buys. But always, guys, risk-adjusted returns, right? You can make a decent amount of returns here if you are willing to absorb the risk of the narrative right now. At least it's not showing in the numbers. And to be frank with you, it's not showing in Oracle's numbers either. But these are two types of trades where you have to structure a thesis with a validation point and an invalidation point. The thesis would be as follows, right? I can invest in Adobe, but if I start seeing their revenue and subscriber growth decline or start to go negative, I will have to close my position. But I will start a position here because the risk to reward is profile. That's how you would structure a longer form thesis on a company like Adobe. So that's everything. We spent a lot of time on these two companies, guys, because it's not as simple as just running through the numbers, giving an estimate and saying go for it, right? The context matters a lot. And I want you guys to learn how to structure a thesis and be able to identify what the numbers are and then understand what the thesis against the company is and derive a good risk to reward position for you, especially in terms of position sizing, right? When you have these types of trades, there's two types of people, right? The people who will just go absolutely against the grain, absolutely against the narrative, and overweight this position and say, you know what? I'm just going to go for it. I don't believe in the narrative. It is what it is. It might take a long time for me to be rewarded, but I'm going to take that chance. See, I took that chance on Google, but Google was a much better diversified business with a very large distribution channel. And we took that bet back here when the Department of Justice threat to break up the business was there, when the threat of AI destroying Google's business was there as well. This was an easier bluff for me to call. Arguably, the bluff on Oracle is tougher than Google, and the bluff to call on Adobe is also tougher than Google. So not all bluffs to call are created equal, guys. Sometimes they're easier than others, right? Calling the Amazon bluff right here is easy for me to do, right? The fact that they haven't done anything, et cetera, that AWS is going to slow down and other people will take over the business, et cetera, right? There's a few bearish catalysts on bearish narratives at play against Amazon right now. The stock just doesn't move, doesn't go anywhere. See, this is easy for me to call. The Netflix narrative right now, right? How the WBD deal isn't accretive to the business. This is an easier bluff for me to call than Adobe and Oracle, to be honest with you. But that's just me. Everybody's different. Maybe Adobe is an easier proposition for you than Netflix, right? Structure your thesis, create the position size that is in line with your thesis, right? And then just take it from there. But don't always give yourself an invalidation point too. It's very important, guys. You have to know what invalidates your thesis overall, right? So that being said, that's everything for your earnings breakdowns. We spent a lot of time on this stuff, but hopefully this helps you moving forward for earnings in the future, because you guys know what I love doing best on the channel, guys, is giving you context and the thought process. I think that matters a whole lot more than me just showing you, numbers on a screen and spending 3 minutes on earnings and just saying, yeah, it's a 20 forward multiple, it's a one peg, et cetera, right? It doesn't matter, right? The context behind the numbers and the narratives often matter a lot more than the numbers in absolute form. That being said, let's get into our charts right now, shall we? We're going to start off with the good old S&P 500. Okay, so moving on to the S&P, guys. Not too bad, all-time high test, but we're going to do it with the futures now. So obviously we know that the bulls are in control of this move right now. However, look at the futures market right now. It's not looking good. Rejection from the all-time highs, right? So in the event we continue to be a bit weaker into tomorrow's trade, Thursday, or rather Fridays as well, you got a very big area of support below us, right? And if we continue this path on the S&P, this is down here, talking about 674 down to about 666, excuse me. We'll be looking for a daily higher low. Yes, this is all one move, looking for a daily higher low for possible expansion into the end of December. The good part of today was that we actually got bullish views on the economy into 2026. However, you will have to get through, guys. It's going to be a battle, right? The long-term bullish tailwinds versus the short-term concerns for the market right now. The AI data center build-out, right? The jobs market will be front and center for 2026 as well, and the status of the consumer in relation to the K-shaped economy. These are all the big three: AI, consumer, and jobs. These will last into 2026, but it comes back to like Adobe and Oracle at the same time, right? If you trust the true numbers, these numbers specifically from the Fed, right? Well, then you would be a buyer. If these short-term narratives are too powerful for you, then you would probably take some chips off the table and wait for a bit more clarity. There's obviously many different types of people with different risk appetites, different goals. So I'll leave it up to you whether or not you want to buy these dips. I will be a buyer of these dips, especially names like NVIDIA and other big tech names that have been just down sequentially here over the past month or so. But I'll never force you guys to do that. You guys have to take on your own risk profiles for that, right? Moving on to the QQQs right now. QQQs, same concept. If we drop into tomorrow, watch 614 down to 605. You can see here clearly, big move down into our support range on the futures chart. That'll look like this. We're going to leave probably a big gap behind us. Down below, 614 down to 605. The VIX will probably be a bit higher tomorrow. So my favorite type of order would be writing short puts under the market on our favorite companies, which is something I always enjoy doing during periods of volatility and periods of consolidation. You are looking for a higher low for possible further trend continuation. We have that bias because the weekly is in favor of the bulls right now too. And the monthly has never been lost overall as well. And we also have bullish seasonality leading to the end of the year with possibly the Santa Claus rally. I mean, at least the macro and the Fed was favorable to us, right? These little AI noise days, well, those are going to be the bearish days, of course, but at least you know that the market has been broadening out. I mean, we took a look at our breadth indicators a bit earlier, but percentage of stocks above their 20-day EMA, you don't really see a problem up here, right? Breadth is better. Percentage of stocks above their 50-day EMA, 58%. The breadth is better. And percentage of stocks above their 200-day EMA, the breadth is also better. So short-term noise declines, for me at least, will be buying opportunities. Moving on to XLF financials. Financials was very strong today after the rate cut day and the forward projections. Daily uptrend is nice. We are challenging now the all-time high range of about $54, $55, right? A lot of the banks, I mean, JP Morgan had a big expense day yesterday. They raised expense profiles by about 5% into next year and also said they were going to be putting a bit more money away for credit delinquencies for credit cards overall. However, the delinquency rate was roughly in line with the last 5 quarters. So it wasn't a blowout and the banks are able to recover a lot of that dip. Well, JP Morgan was, and the other banks are just pushing right now. Bank of America, not too bad. Wells Fargo, not too bad. Citigroup, not too bad, right? But you do have some weakness a little bit here in the credit card companies, Visa, MasterCard, even American Express. Was down, well, previously. They had a fantastic day today, but Visa, MasterCard, and a few other names like S&P Global and a few names like Moody's Corporation as well, which really hinge upon an accelerated rate cut path. These SPGI and Moody's to be specific because of the debt refinancing pipeline that these companies will be making a lot of profits from. So financials are good right now, guys. You got a lot of support below 53.30 down to 52.83. And the weekly uptrend is going to be, they're going to make an attempt at the weekly uptrend. And the monthly is also looking not too bad for expansion into 2026 because of this. The summary of economic projections, right? What the banks don't want to see is projections for higher unemployment rates and higher inflation overall. Although they won't get their net interest margins higher because the rate cuts won't be coming quickly. Well, at least in terms of the direction for the overall markets, they make a lot of money on trading revenues, right? At least, and the consumer supposedly not falling off a cliff as of just yet. So there are several bullish points for a lot of financial stocks out there. Moving on to healthcare overall. So healthcare undercut the daily uptrend. Higher lows are right there. They undercut. So that being said, the daily uptrend is now lost. Unfortunately, they're going to have to get it back, right? 2-step process of recovery more than likely. Now, on the weekly, we were talking about this, right? It was weekly overbought conditions. It was daily overbought conditions too, and it needed a bit of a pullback. And the pullback we have now gotten. So that being said, weekly is a nice uptrend right now, looking for a higher low. We'll see if healthcare is able to kind of keep this day up or if they just get dragged down with the rest of the market into tomorrow. That being said, the entry opportunity is maybe down here, 148.50 down about 145. If they backtest this location, I probably will be buying healthcare back again. You might remember we bought healthcare down here, closed take profit number 1 and take profit number 2. Very good trade. And if they give me the revisit trade, especially on the monthly here, cup and handle like this into 2026, I might be willing to participate. So this would be the reentry for me for healthcare overall. Moving on to semiconductors right now. Decent, right? 1.4% on the day, but tomorrow, this is probably going to be big red, guys. We'll see if Broadcom can save us. but daily downtrend into a nice engulfing move, arguably a little bit extended on the price right now. You can see that very clearly, right? So you got a lot of space right now to set up some higher lows. Anything above 315, looking for a new daily higher low for possible further trend continuation. So now that the bulls have established their dominance, a little bit of short-term consolidation is not the worst thing. And as a result, I would be a buyer. Why? Because the monthly is still looking good. The weekly trend is still looking good as well, even if we do have a bit of consolidation, right? This consolidation phase for me, since we do control the higher time frames, is going to be a nice opportunity to pick up some of my favorite semiconductor stocks if they show weakness into tomorrow, but also sell puts under the market. Sell put orders tomorrow will probably be very nice indeed. Moving on to the Russell right now. The Russell as well, not too bad. Daily uptrend. They really enjoyed that rate cut today and the Fed's forward projections, right? What the Russell needs is good projections for growth and whatnot. They don't want to see recessionary data. If not, growth is just not going to perform, right? Nice daily uptrend. New higher lows are set right now at about 250. If you lose those, you just end up into daily downtrend and into weekly consolidation. I know I'm going a bit fast, guys, but none of this has changed, right? You guys should be very familiar with this stuff right now. Nice engulfing move on the weekly. We had the weekly uptrend. They lost it. Nice engulfing move. Now they will have to get it back a little bit, right? A big component from the Russell going up today higher was KRE, regional banks. We know it's a big component of the Russell. Regional banks carrying the Russell a bit higher today. So any further consolidation here, if they do lose this move overall in the next few days and we get consolidation, just know what they're going for here. Weekly higher lows for possible further expansion into 2026. The growth stocks, the Russell, not looking too bad, especially not with this economic landscape into 2026. But as I said, you're going to have to get through the short-term noise. If you're bidding growth stocks, if you're bidding the Russell and things like that, right? You're going to have to get through these short-term noises, right? The AI bubble, the job softening, the K-shaped economy right now, because all of those things are going to hinder growth stocks, momentarily. There's going to be some, let's just say it's not going to be as easy as it was in September and October or many times prior throughout the year. I will kind of skip through the other names here just because the video is very long right now. So I'll be doing a big recap of these tomorrow, Friday, as we always do. We do a big recap here of the other components of the market, but notable gains here on the day on XLP, consumer retail as well. A lot of names have been coming back there. Utilities somewhat muted, but that was because of the big uptick in yields, and real estate as well has been muted because of yields overall. So we will see after a day like tomorrow, the futures market not looking the best, but I think a lot of that's coming from tech. We will see, guys. Pay attention tomorrow, man. Have the heat map front and center. If it's only tech that is down because of Oracle, but the rest of the market is there to pick up the slack, then it's not too bad. If it leads to an overall sell-off, well, you might know that, on the indexes, you may be heading into a bit more consolidation than just one single day from the Oracle event overall. So please keep that in mind. We'll be doing a bigger recap of all your indexes tomorrow. The VIX was down today, but I would not be surprised if the VIX does move a bit higher into tomorrow because of those Oracle earnings and the 10 and 20-year yields. I mean, now we got a nice drop here, guys, but we've explained this many times. The yields are a very complicated trade overall, right? And overall, since the end of quantitative tightening, well, unfortunately, we've moved a little bit higher. So we will review these yields progressively. But, when you don't get further rate cuts, when they stay firm right here, the yields, the 10 and 20, will move a little bit in the short term, but will not move in an accelerated fashion. The one thing that you have to do to have these 10 and 20 year olds drop, 10 and 20 year yields drop significantly is you have to get fully rid of the tariff inflation narrative. That has to go away. And also the federal debt levels as well, right? We know that the administration has been bringing in a tremendous amount of money from tariffs, but the reason that these yields are high is because the risk premium is high, right? It's tough to ask institutions and foreign governments and foreign institutions as well to invest in the US if the threat is for dollar devaluation, if the threat is the unsustainable level of debt to GDP, and if the threat is persistent inflation as a result of tariffs. Larger institutions and foreign governments will want more risk premium on the longer end of the yield curve, which is why your 1 and 2s are dropping in line with the federal funds rate. But the 10 and 20s are staying higher because there are still some overall, longer term risks to the US. Not my words. This is what the bond market is telling you, right? That being said, that's your preview for that. Moving on to gold right now. Gold has just been doing a whole lot of absolutely nothing. We're stuck. Absolutely stuck. They're setting the daily higher lows right now at about 41.72. It was a nice daily uptrend, but now we ran out of gas. Tightening range. Whichever way this range breaks, guys, is going to determine whether or not we go further into daily uptrend and whether or not this weekly can continue to have some legs, or if you break this to the downside, guys, right? Well, at that point in time, you might just be going into extended weekly consolidation, maybe a further backtest down here of 4,000, similar to what we did back here, right? Just tightening range. Maybe another tightening range is upon us into the end of the year. I mean, whichever way this range breaks, we'll give you that information, right? If it breaks hard, we will see if the bulls get more momentum. But if you break down, guys, you know, the monthly has been overbought now for a very long time. The weekly, although trying, you know, if you ask me my gut feeling, guys, we might just go into some form of a tightening range right now, in my opinion, right, into the end of the year, which is why I did close my gold longs when the price action struggled a little bit up here. That being said, I'm just patiently waiting on the sidelines now for gold. Long-term positioning is still fine. If you believe in the $5,000, $6,000, $8,000 per ounce thesis on gold over the next few years, then you would hold. But if you're swing trading, right, and you see price action like this, well, the stop loss should be on a break of the daily downtrend down below there, yeah? Moving on to Bitcoin and crypto. Well, I wasn't with you guys yesterday, but you can clearly see still struggling, right? So the daily uptrend right now is an absolute mess. They're trying, but on the weekly time frame, this does look like a bear flag, doesn't it, right? So now it's reacting in the after hours to the risk on trade and the Oracle earnings, even though it shouldn't, right? It's all part of the risk on trade, guys. You know, you haven't seen the same level of momentum, no matter what you're looking at, right? A few names here and there are doing really well, such as Rocket Lab and stuff like that. You know, even some of the quantum names, they pumped up a little bit, right? But you're not seeing this, okay? On a lot of things, right? You're not seeing it on NBIS, Iris Energy, CIFR. Some names popped up higher than others. APLD, I will agree with you. Some names had great recoveries. That name, Rocket Lab as well, with some news that they had. ASTS with the whole data centers in space, right? Some of them, you're seeing this, but broadly speaking, the biggest winners of September and October, a lot of them are still quite muted, and even Bitcoin, right? Bitcoin and gold, a lot of these easy, crowded trades are just not so easy anymore, right? Bitcoin and Ethereum have their own problems. There was the whole liquidation events, the lack of liquidity overall in the crypto market, and as a result, I mean, the ripples are still being felt. We just do not have a big pivot back to the risk on trade. And you don't even need to look further than some of the big tech names, right? A lot of the big tech names, guys, we'll cover them later, right? It's just not moving the same way that it did earlier because of the bearish narratives in the market right now. It's very choppy. The market is very, very choppy right now. Push and pull. Bitcoin is exactly the same. Push and pull. They give you hope going for the expansion and get rejected again at 94,000, right? So if you see a break of this, 87,700, sadly, that's a new daily downtrend. Sadly, that is the end of your weekly bounce. And unfortunately for Bitcoin, that was not a very big weekly bounce, was it? It was a 38% bounce. So that being said, it doesn't guarantee the bears will get full follow through. If anything, you might just revisit these lows and we'll see if the bulls can play defense. However, right, you don't want to see a bear flag like this into, well, what formerly was support, but now acting as resistance, because it just leads you to believe, right? If these market short-term narratives can't get together, if we cannot see the risk on move, if we cannot see the broadening out back to, full liquidity and full bullishness, right? Well, crypto is just not going to have that move either, and you could possibly expect a retracement down. So short-term price action, very choppy. Am I buying Bitcoin for the very long term? Yes. But am I swing trading it in the short term? No. The price action is very, very choppy. These are the types of trades I'd rather wait and see for, right? Moving on to Ethereum, same thing, although Ethereum gained a little bit more ground than Bitcoin. Nice daily uptrend, right? We're looking for a higher low, anything above 29, looking for a daily higher low, maybe for further trend continuation. Now, how high have they gotten in relation to this weekly sell-off, weekly downtrend, right? Well, not too bad. Not too bad. Better than Bitcoin, 50% retracement, which gives the bulls roughly 50% chances of when this daily uptrend finishes, if it does, right? It gives the bulls a 50% odd of setting the higher lows on the weekly and going for the weekly uptrend shift. That is not set in stone though right now. We are still into support, 32.50 down about 28.36. A lot of people have been asking me, is it time to buy Ethereum? If you have a long-term thesis, it might be time to pick up, right? BMNR has had a phenomenal rally off the lows with the Ethereum break, right? But short-term swing trades, guys, are going to be very choppy. As you can see, crypto's not moving on its own. Sometimes it moves on its own, and then other time, it seems as though, right, crypto doesn't get any of the bullishness from the rest of the market, but it gets all of the bearishness recently, right? And that's just synonymous with the risk on trade. The liquidity isn't there. The risk on pension isn't there, at least not as much as it was earlier this year. So that being said, is it a decent time to buy Ethereum for a long-term thesis of expansion of the stablecoin markets, right? Expansion of the back end for the banks, all the thesis, all the various elements of the thesis that Tom Lee has and other people has. Yeah, but will the price action be very choppy in the midterm? Absolutely. So long-term buys, yes, but short-term buys, you're going to be very choppy in the near-term future. At least that's my opinion. And now that's everything for your overall market rundown. I know we're going fast, but we've got to do it. Probably won't have time to do the biggest gainers and losers today either. So we'll spend more time on that tomorrow, I promise. Now, moving into our big tech names. All right, so talking about Apple. Apple kind of doing its best to hold up the markets, but we did have 5 days of consolidation. The daily uptrend is still very nice on Apple, right? Nice daily uptrend. Higher lows being set. Support stays put 275. Down about 267. The bulls are still fully in control right now, but the weekly, as you guys know, is a bit stretched on the price, although it's a very nice weekly uptrend overall. Still, right? A little bit stretched on the price right here, which means no swing trades for me on Apple at weekly overbought conditions, nor when the monthly chart, is stretched from the 12 EMAs. I would prefer to see Apple do something like this, right? And then give me an entry for a possible swing trade. Am I selling any Apple shares up here? No. Are the bulls still fully in control? Absolutely. But going long from Apple right here is somewhat of a very greedy trade. I mean, I guess you could kind of price one thing out, which would be a stop loss below here, and then expansion target into maybe 300. The risk to reward does make sense on that type of shorter term swing trade. As you can see right here, it is not that bad, right? It's like a 1.6, 1.7 to 1. It does make sense to go for that 300 psychological level. A bit of a greedy trade, in my opinion, and should not be done without a stop loss. Long term, am I buying any Apple shares up here? No, you guys know me. I like to find nice confluence with a monthly pullback into a large level, plus more favorable fundamentals. But overall, Apple's valuation right now is a little bit rich, right? So I'm not buying any shares up here, but I'm also not selling any shares up here. I'm just holding Apple for now. Moving on to AMD. So AMD is down 0.09 in the day. AMD hasn't done anything. Absolutely anything. But tomorrow, I assume with these futures like this, I assume AMD will probably have a decent red day, which could be a nice opportunity to sell some puts, especially on an uptick of the VIX. 190, down to 175 would be the region that I would be targeting to sell puts into, because that's previous big resistance. It is also current support. The problem with AMD is that they are psychologically tied into the OpenAI landscape, right? Now, because of that big deal that they signed for 10% equity. Now, that being said, short-term price action is very choppy right now, and it's a daily uptrend, right? But if you lose this guy right here, 212, into tomorrow, daily downtrend, weekly lower highs are set, and you might just be looking for another leg, yes, another leg of consolidation, maybe back down into my support level. And this would be an area that I would not mind buying any shares for AMD, because the growth pipeline for AMD does not entirely hinge on OpenAI. No, they will be shipping their products to many other different companies overall, yeah? But, I mean, Oracle is a big deal in there. OpenAI is a big deal in there as well. Not all, but some. Enough that when you have some worries surrounding these two companies, sadly, they will bring down AMD. Not only AMD, they'll bring down NVIDIA as well, right? So that being said, at $200, fundamentally speaking, AMD is a pretty good deal, right? It's a one peg, it's a 7.5 price to sales. And overall, similar to other companies, a lot of the big growth boom for AMD will be coming late 2027 into 2028, and revenue as well, late 26, 27, and 2028 as well. So I do want to position for some AMD shares here that I will be carrying into the next few years, but AMD's price action may just be a little bit choppy in the near-term future for everything we've talked about in the current video today. Moving on to Amazon right now. Amazon was up 1.7% today. Not too bad, right? So that being said, daily downtrend, nice bounce here. It was a very decent bounce. We talked about that, right? A 618 bounce, but depending on the futures, who knows if they drag down Amazon as well. They are trying to go for the daily uptrend reversal, which would need a break of 238. And today, they did turn around the hourly uptrend, which is also a very good sign, right? That's what lets you know that the short-term consolidation is finished. The bulls, are looking to make a bit of a move higher. Now, sadly, if we cut these lows, it's going to be daily downtrend. It's going to be just a continuation of weekly consolidation. So Amazon, right? I know the short-term price action is choppy. The only thing you need to understand about this company is that we're trapped. We're trapped between two very big levels. Big resistance above, which ends at 240, and then below support, which is down here at about 220, down to about 205. Now, I will be playing the support range whenever Amazon dips down and gives me an opportunity to sell some puts under the market, or accumulate some long-term shares around the 220 range, I will be doing that for as long as Amazon offers that opportunity, because I do believe around 220, the fundamental valuation is quite fair at a 28 forward PE and a 1.4 PEG, and offers very nice support for any short put purposes. I have 3 types of trades I'm doing on Amazon right now. Shares for the long term, leap call options for the eventual expansion of Amazon into 2027, which is why my leaps are December 2027, and short puts under the market to generate a little bit of premium during this range of consolidation. Moving on to Google right now. Google, 1% to the upside, not too bad. A little bit of consolidation here into the 12 EMA. Google is still somehow holding these highs in spite of being weekly overbought, in spite of being very monthly overbought as well. This company is just very bullish, right? People just don't want to give back the levels, or at least the bulls holding the defense very strong. Pay attention though, 312, right? Lose 312, continuation of your daily downtrend, and maybe just embarking on a bit of weekly consolidation into maybe the weekly 12 EMA down here at like 290, 280 type of stuff, right? And that's the previous range. I mean, it's not that solid because Google didn't really bother setting many support levels on the way up. The next one is down here 280, and then below that is about 250. So Google, I'm not necessarily trading up here at all. I think the price is very extended. Weekly is overbought. Monthly is super far away from this 12 EMA. The time to position for any swing trades on Google was during this moment in time back there when you had to derive a thesis to call out the narratives and call the bluff for the market, right? Now that we've made a bunch of money, I've closed most of my swing trade longs on Google and I've reallocated the capital to other names in big tech that have not ran as much. That being said, at 320, is Google a terrible buy? No, it's a 29 forward PE and a 1.91 PEG. So it's not crazy expensive, but can we say it's cheap anymore? No, it's trading towards the higher end of historical valuations, but the bulls remain in full short-term control right now. Moving on to Meta right now. So Meta has been down the few past days in a row, right? But we know that the bulls did a good job in setting a daily uptrend. We got support down here, 645 down about 630 is a little pocket. It's not the strongest level, I will agree, right? Not a very strong level at all, but it is the closest one we have, and it is in line with your daily EMAs too. We'll see what happens overall in Meta. If you want more clarity, just zoom out to the weekly. Weekly is a downtrend with a nice bounce. How high did the bounce get so far? 50%. Meaning, if Meta loses this, if they go into some awkward form of a daily downtrend, the bulls have a good chance that this is your weekly high or low, and that we are going for the 2-step weekly uptrend recovery. Now, how am I playing this on Meta? Very simple, right? With a big account, I would be selling puts down here on any further weakness, and I'll be adding some shares on Meta, especially lower than 630, because around 630, the valuation is quite compelling. A low 21 forward PE and a 1.63 PEG. Not very bad numbers for Meta at all. So I want to keep building my long-term share positions in this company that is still down from the highs right now, still down almost 20%. So we're going to make the most of these discounts, right? Moving on to Microsoft right now. Microsoft down 2.75% for a few different reasons. Number one, they're investing $17.5 billion in India. That news was released yesterday, late in the afternoon. And today as well, they're also dropping $7.5 billion in Canada. So more capital expenditures for Microsoft. And Lord knows that the market has not been receiving capital expenditures in a very good fashion recently, right? There used to be a time where CapEx was rewarded. And now, sadly, CapEx is not being rewarded because people are saying, are they spending too much money too soon? Could they even afford all this stuff? Well, Satya Nadella, the CEO of Microsoft, said it himself. We're not sure about other people, but Microsoft is good for its money. And I also believe that as well. That being said, rejection at resistance right now, 502 down about 488. Big rejection here, big resistance range. It was support for a while, now resistance. Price action is very choppy. Sadly, if you undercut these higher lows, they tried to go for the uptrend. You undercut this, guys, sadly, that's it, man. Daily downtrend resumes and a new weekly leg of selling starts as well. The final resting place for Microsoft, in my opinion, is probably down here, 452 down about 430. That would be a hell of a sell-off, man. If you go all the way down there, that would be 18 to about 22%. It's usually always been a great opportunity to buy Microsoft on a 18, 20% sell-off, especially when you can find it between the 12 and 26 on the monthly. Huge support into the pocket. And this pocket is the one that I want to play, guys. I've been very vocal about this on the channel, right? 470 down to 450. I am a buyer of Microsoft shares at that valuation down there. They're under a 34 price to earnings, a 1.66 PEG, much more manageable than up here at 550, 560. And as a result, I was buying nothing on Microsoft up here. Now I'm starting to add to my long-term share position. And you can tell in the context of bull markets, right? Has it usually been a good proposition to buy Microsoft when it gets below its 12 EMA, closer to its 26? The answer, quite frankly, is indeed yes. And so I will be trusting historical precedent and historical multiples to, take those shares into my account, essentially. Moving on to Netflix. So Netflix down another 4%. Why? Well, because they stepped up their bid again from 70 something, right? 72, 74 billion, whatever it was. Now 82.7. So every day for the past week, it's been Netflix versus Paramount. Paramount steps up their bid to 108. Netflix comes in again, 82.7. Netflix has the signed deal, but then Paramount is putting over the hostile bid, going directly to the shareholders, providing more in terms of price per share. All a whole bunch of noise. And you guys know when something gets very noisy, the price tends to get very noisy as well. That being said, Netflix is coming into a very nice area of support right now, which is into the 26 EMA, $90. And below that is pretty much 86 down to about 82. This was the last area of the tariff. So apparently people are more uncertain about Netflix now than when we had the highest tariff posted rates, effective rates in over 100 years. So forgive me for wanting to call the bluff on this one, but as a Netflix shareholder myself, I do believe that whether we get the deal or not, if we get the deal, it's going to be accretive to the business in the long term. We get some very nice production studios. If we don't get the deal, well, then they'll be able to reverse this price action instantly. So it's win-win. If they don't get the deal, well, all this short-term noise goes away and Netflix share price probably recovers, right, by the amount that they've been pressured from the deal. If we do get the deal, well, Netflix share price may come into short-term pressures, but the long-term thesis gets even better, right? We know that whenever we're looking to invest in Netflix, just think of the long-term thesis. Long-term thesis is a company that has very high net margins, generates good free cash flow, generates EPS expansion, has a very high subscriber retention rate, and as a result, can keep increasing revenue. And they also have very good pricing power, right? Netflix runs a very sticky service. So am I buying Netflix down here? Yes. Was I buying at 100? Absolutely, right? I will be buying all the way into this little pocket. Has it been a good proposition to buy Netflix between a 12 and 26 in terms of historical standards when it's not a big bear market like 2022 or a global pandemic? Well, I guess global pandemic, everybody stayed at home, right? But Netflix has shown some good price action throughout its history, and I will be a fan of buying here. Now, we do have the monthly MACD cross. That doesn't mean that we're going to do this. It just means that momentum has been lost on the monthly, and it may take a while to recover that momentum. But long-term picture for Netflix is still very clear if you can get beside the short-term noise. A lot of investing guys has been able to identify signals from noise. A lot of people get shaken up too much by short-term noise. I hope you guys don't get shaken up by short-term noise if you have a long-term thesis on a business, yeah? Around $100 or lower, I mean, now we're much lower. We're like almost 10% lower than that. You're now finally trading under a 30 forward multiple. And it's a 1.54 peg, now probably closer to a 1.4 peg. You haven't been able to find Netflix at these valuations in quite a long time. So Netflix is an attractive opportunity, in my opinion. Daily oversold conditions, support area, kind of peak uncertainty, peak FUD surrounding the deal right now. All those criteria lead me to believe that Netflix is a good buying opportunity. But am I going for short-term call options, trying to say that this is the bottom, this is the bottom, this is the bottom? No. Longer term plays such as leaps and short puts under the market and long-term shares as well. Moving on to good old NVIDIA. NVIDIA down 0.64% today. NVIDIA just can't do anything, man. And probably into tomorrow, they will be red. You can see that in the after hours. Well, sorry, I don't have the after hours on. In the after hours, they drop by what? What is this, like 1%, 1.5%? So NVIDIA probably will be down tomorrow. And once again, we are trapped in the gulag, right? Unable to break above 185. 185 to 180 has been a magnet for this stock many times in the last, well, since August, end of July, pretty much, right? That being said, the more NVIDIA consolidates sideways with such good earnings, the cheaper it becomes, right? Whereas as of right now, the valuation on NVIDIA around 180 is a 26 forward multiple and a 1.15 peg. Very fair valuations for this company with super solid growth, in my opinion. But the short-term narratives are what's plaguing NVIDIA right now. That being said, any declines, be very honest with you, what I'll be doing, buying more shares for the long term, selling some put options down here into my favorite area, which is 165, which would just be a full monthly retracement to the good old 12 EMA. The company at that point would be down 22% from the highs. And if we've learned anything throughout this massive NVIDIA rally over the past 3 years, is that whenever NVIDIA is down 20+% from highs, for ever which reason, it's usually been a very good buying opportunity, especially if they have the growth to back up those, to back up the, essentially the valuation, right? Which is indeed true. So I will be a big fan of buying NVIDIA. I know it's not been very easy recently. It's been very choppy, but eventually NVIDIA will resume to its trending nature. But you're going to have to get through, a lot of the OpenAI drama and things like that, right? The market is just lacking clarity surrounding AI. Everybody knows the build out is going to happen. It's like everybody knows the long term is good, right? Everybody knows that the demand is insatiable, that the infrastructure build out will be here for the next 3-4 years. But people are just nervous about committing now before we start to see the big numbers, which come end of 26 into 2027. That's the problem right now, right? It's kind of like you did this, right? This year or late last year, you did this, right? And now we have a gap here. There's like not much to show for AI until late 2026, 2027, when you get actual numbers. So we priced out a lot of the AI growth story, but now it's like, when are the numbers coming? And there's a gap. And because there's this gap, people are starting to get a little bit nervous, starting to question long-term thesis, starting to question whether or not it's a bubble, right? That gap is what's causing the issues right now. Moving on to Tesla. Tesla, 1.41% to the upside. Not too bad of a recovery day for Tesla overall. That being said, daily uptrend was never a question. Higher lows are set 436, and the bulls are looking to expand. However, if it gets dragged down with the rest of the market tomorrow and we flush daily downtrend, you guys know the drill, right? Just going for a bit of a weekly higher low. Support stays put 427 down to about 416. You'd be looking for something like this, right? Nice move by the bulls, I will admit. Weekly downtrend. This was a very nice retracement size on the weekly timeframes right there, 78%. So you got a lot of room, man, above the weekly higher low, 387, to set up a new higher low and maybe go for the ever so elusive all-time high break on Tesla overall. But the monthly is not looking too bad, right? Even a bit more consolidation here wouldn't be so awkward. This is a bull flag. There's no other way around it, right? So even if we come back to 404 to 380, if you're looking to play Tesla, if you have a very bullish thesis on Tesla, right? Just try and play this pocket as much as possible, that whole 400 range. But I mean, you do have to have the long-term vision for Tesla, the FSD vision, the robotics vision, the energy vision as well, right? That being said, the short-term negative catalysts are not going to do it for you surrounding the car business, because the car business has been somewhat soft. And, with the 10 and 20-year yields not dropping too much and longer-term interest rates not dropping too much, people are still just not buying cars that much. Not buying houses, not buying cars, not renting their homes, anything with big levels of financing, people just aren't doing. So short-term car business may still come under pressure into the next 2 quarters, but the long-term thesis is still there for most people. Moving on to the next few, Palantir right now. So I'll try to wrap this up quickly. Palantir, very decent day of expansion here, 3.34%. Daily downtrend, nice move by the bulls, man. They're trying to reclaim this entire resistance range. We weren't sure if they were going to have the juice to actually get through this. Apparently so. So now that we're above it, now we can then use all this area as a fallback in the event we run out of gas shortly, looking for a higher low for possible further trend continuation. Palantir looking very strong. The weekly move is also nice. We lost the weekly uptrend, right? Lost it. Now they got to get it back. So if we have to get it back in 2 legs, if Palantir gets sent down with the rest of the market tomorrow, and you look for daily consolidation, just look for this, right? It's a nice daily uptrend, right? Looking for a daily higher low for further expansion, and weekly the same thing, looking for a weekly higher low. So as a result, if you're looking for a swing trade entry long, you would play the bottom end of the support range, 170, with the stop loss below 150, and then you're targeting 220 probably expansion, right? 220 upside break, right, of the 210 area, probably 220, 225 psychological. That's not a very bad swing trade. It's not terrible in terms of risk to reward, right? So just keep that in mind if you're looking for short-term swings on Palantir. And long-term shares, you guys know the drill. We covered this, man. The only reason you would buy Palantir up here is if you are going to hold it for the next 5-10 years and you do believe that the market cap can expand into $1 trillion+ business. Only then would the compound annual growth rates make sense buying this stock all the way up here. Moving on to SOFI right now. SOFI responding well to the Federal Reserve meeting today, right? That being said, the price action is still somewhat choppy. So daily downtrend, nice engulfing move by the bulls. They still have a lot of space, right? Anything above 2366, still looking for a higher low for possible expansion. Now, if SOFI gets dragged down with the overall market sentiment tomorrow, well, it's still a great opportunity, guys, to do 2 things. Number 1, we'll be buying some shares for the long term at $27 or lower. It's pretty good. It's a 1.1 peg and a mid-7 price to sales metric, which is great. It means that you're getting some decent upside in terms of compound annual growth rates. If you believe in the next 2-3 years, SOFI will be able to grow into a $50, $60 billion company. There is still some nice upside here for possibly buying some shares here into our larger area of consolidation, 25 to 22, which the bulls have used as support for a very long time, which is the highs from 2021, 2022, and your monthly higher low region, which the bulls have been playing some nice defense, something like this, right? If you go a little bit lower, wouldn't be so crazy, but here is definitely an area where I am interested in adding a little bit more SOFI and also playing short puts, just writing some put options down here. If they come down and pick me up, no problem at all. That's where I want to pick up my wheel trades, right? If they don't come down and pick me up, no problem. I'll just keep farming premium. That's why SOFI has been so lucrative when they come down to this area, because we've been farming puts down here for literally the last 3 months without any assignments. I wouldn't mind being assigned, but that is the best way to do it, kind of building further long-term shares during this accumulation zone, but also funding those shares with a little bit of premium that you're collecting from selling put options. Moving on to Uber right now. Uber was down like almost 7% today, guys. And this is after like a few key headlines came out, in terms of, well, this one right here. Okay. So I don't know if I can see this one right here. They were down because they ended monthly bonuses for electric vehicle drivers. So that was a big headline, but also, the Waymo statistics came out yesterday, Tesla's FSD expansion. So there's a few key things here. Number one, Uber suspending EV bonuses for its drivers. There was some protests against Uber in Europe as well. And additionally, you had some headlines from Waymo and Tesla, all of those things kind of impacting the price on Uber over the past 2 days. So Uber is also a company with a solid long-term fundamental outlook in terms of their mobility and deliveries growth. They still have a ton of monthly active users, a ton of bookings, record amounts of trips, but this one also has a cloudy theme. Like AI, man, is such a complicated trade sometimes, because for some companies now, the companies that used to have a very clear thesis, in the last year, you faced a lot of pressures, right? Adobe was feeling it. Salesforce was feeling it. Even to a certain extent this year, Google was feeling it, right? Even companies like Uber have been feeling it recently with autonomous vehicles and whatnot. I mean, Uber's been kind of going against that narrative for the past 2-3 years, but there's been an acceleration of that narrative or the pressures from AI against many companies this year. Once again, another company that is facing the pressures because of that. Now, objectively speaking, are the numbers good on Uber? Indeed, yes. At 83, we're sitting at a low price to earnings multiple, a 1.5 PEG, and a 5% free cash flow yield. So when the fundamental numbers are good, I don't mind taking a stab at this against the AI narrative, because I've said it on Uber a lot, right? I do believe that it's not going to be one or the other, at least not for the next, 5, 7, 10 years. I do believe that there will be a synergy between Uber's network effects and the autonomous vehicle rollout, right? Keep in mind, Uber serves many portions of the world that don't have robotaxis just yet at all. So the robotaxi ramp is going to take years and years and years and years. So we can possibly still see years and years and years of growth for Uber as well, which is why I stay invested in the stock, and which is why I do want to sell some put options down here in the low 80s down to 70s. I think the multiples are fair. I think the monthly retracement is also very nice right now, looking for a very wide breakout retest on the monthly for possible expansion into 2026. And the fundamental thesis, kind of like Adobe, right? Even though the short-term price action has been kind of awkward recently, I mean, you take a look here at the long-term fundamentals. I mean, EPS moving up through 2028 and revenues moving up as well. And they literally gave us earnings in November, record bookings, record monthly active users, record mobility and deliveries segments as well. So the fundamentals are there for Uber, but you will find these days, every now and then, where it just gets caught up in sentiment and narrative. And as a result, on those days, I will be a buyer. Moving on to TSM right now. TSM blasting through the top. We will see if they're going to be down tomorrow, but new all-time high for TSM. Huge move by TSM bulls right there, guys. We will see with Broadcom earnings tomorrow whether or not they're able to breathe some more life into the semiconductor niche. That being said, if we fall tomorrow on TSM, looking for a higher low, anything above 283, looking for a higher low for possible further trend continuation. And that being said, the weekly is still in control right now. Support is down here, 280 down to 270. So I'm not bidding TSM right now, but we have a nice established area of support. They didn't really come down that much on the monthly, not as much as I would have liked to see, but I'm holding all my TSM shares. I'm not buying any more up here. We've been very clear on this, right? The valuation at 295 is fair, I guess, for a nibble. It's not super cheap anymore, but it's fair. I'm not selling any of my TSM shares. I'm not adding any more. TSM is just a hold for me at this point, and also I'm not doing any swing trades on TSM either. I'll be looking for names that have consolidated a little bit more in terms of price action for any large swing trades. But that's it for me, guys. I try to keep the video under an hour and a half. We had a lot of things to talk about. Hadn't seen you guys in 2 days. A lot of narrative discussion, right? A lot of Federal Reserve discussion, a lot of earnings discussions. Hopefully you guys enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday to Friday, except for some rare occasions when I'm busy. And last but not least, if you have any questions, please feel free to leave them down in the comment section. Tomorrow, we'll do a lot of things, guys. We'll spend more time on the market breadth, market rotation. We'll spend some time on the biggest gainers and losers of the day as well, and into the Friday session too, right? Thursday and Friday, we'll do a lot more deep dives into the technicals there. So thanks for watching, guys. Have a good night. Apologies for the late upload and for missing yesterday as well. Tomorrow, normal schedule, I promise. Take care. See you soon. Peace.